Welcome to the deep dive. Today we're not talking about the markets, but about the machinery behind them. We're going deep into fund structuring in one of the world's major hubs, Luxembourg.
That's right. Our goal here is to build a clear map for a professional investor, someone who needs to know exactly how to construct a credible, regulated hedge fund in that jurisdiction.
So this is the institutional playbook.
Precisely. We're getting into the mechanics, the legal structures, the mandatory oversight, and of course, the tax framework that makes it all work. It's the due diligence checklist.
And it all seems to circle back to one core concept: credibility. Luxembourg is a hub for huge sponsors and family offices because of its stability and, really, its total alignment with AIFMD.
The Alternative Investment Fund Managers Directive, yes.
And that's the key that unlocks European capital, isn't it?
It's the entry ticket. It's non-negotiable. I mean, the strength of Luxembourg isn't just one thing. It's the whole ecosystem that's been built around AIFMD compliance. That's what sets it apart.
Okay, so let's start at the beginning. The first decision you have to make is the legal wrapper for the fund. This choice dictates, well, pretty much everything.
It does. And there are three main options on the menu for professional managers. You have the CSP, the RAIF, and the SICAV. Each one serves a slightly different purpose.
Let's start with the SCSP, the Special Limited Partnership. This one feels, I don't know, very familiar. A bit like the classic partnership model.
It is. Its main appeal is flexibility. It's a contractual partnership, so it doesn't have a separate legal personality.
Which means it's tax transparent.
Exactly. It's a flow-through. The entire thing is governed by the LPA, the Limited Partnership Agreement, which gives managers enormous freedom. You can build incredibly complex distribution waterfalls, tailor all your governance. It's very bespoke.
But there's always a trade-off with the partnership model, right?
Right.
The general partner, the GP, still has unlimited liability.
That's inherent to the form, yes, though in practice the GP is usually a limited liability company itself to shield it. But you're right. That structure, though, is why it's so popular for strategies like private credit or real assets where you need that maximum flexibility from day one.
Okay, now let's talk about the one that's been getting all the attention. The RAIF, the Reserved Alternative Investment Fund. The big selling point you always hear is speed.
It is incredibly fast. The RAIF pulls off this clever balancing act between regulatory credibility and just raw operational efficiency.
How does it do that? What's the secret?
The secret is that the RAIF itself doesn't need to be pre-approved by the SCSp, the Luxembourg regulator.
Oh, interesting.
Instead, it pushes the entire supervisory burden onto its mandatory external AIFM, the fund manager.
So you get to skip the direct regulatory queue, but
Yeah.
you're still fully compliant because this AIFM is acting as a permanent institutional watchdog.
Exactly. The AIFM carries all the regulatory weight, so if you have your documents and your service providers lined up, a RAIF can be up and running in a matter of weeks.
Weeks. That's a huge advantage.
A massive advantage for managers who want to deploy capital quickly. And it's still very flexible. You can use derivatives, leverage, you name it.
Does the lack of that direct CSSF stamp of approval ever worry some of the more, let's say, conservative institutional investors?
It's a fair question. You might get a query from, say, an ultra-conservative sovereign wealth fund, but honestly, the market acceptance is so high now, the credibility of the AIFM and the depositary is usually more than enough reassurance.
Okay, and the third pillar is the SICAV-RAIF, the investment company with variable capital. This sounds much more like a traditional corporation.
It is. It's for investors who really prioritize that established corporate governance feel. It's a corporate vehicle. It has a board of directors, a formal shareholder structure. It's very familiar to institutional allocators.
And what kind of strategy would naturally fit into a SICAV-RAIF?
Usually more liquid strategies, things that need daily, weekly, or monthly NAV calculations. It's often set up as an umbrella structure too, so a manager can have multiple segregated strategies all living under one corporate roof.
Okay, so once you've picked the wrapper, the SCSP, the RAIF, or the SICAV, you need to build the engine. Let's move on to the governance layer required by AIFMD.
Right. This is what we sometimes call the service provider triangle. You can't launch without these three in place. It's the AIFM, the depositary, and the administrator.
Let's start with the AIFM. We've mentioned them already. They're obviously picking the investments, but their job is much bigger than that.
Much bigger. They are the regulatory centerpiece. Yes, they do portfolio management, but they also have to approve the fund's entire valuation methodology, oversee liquidity, run stress tests, and constantly monitor leverage.
And crucially, they're the ones who hold the AIFMD passport.
Which is the key to distributing the fund across the entire EU without friction. It's a huge operational benefit.
Okay, next up in the triangle is the depositary, the custodial watchdog.
That's a good way to put it. Their job is to safeguard investor capital.
So what does that mean in practice? Are they just checking boxes?
No, it's very active. They oversee all cash flows, making sure subscriptions and redemptions are handled correctly. And critically, they have to independently verify the existence and ownership of every single asset in the fund.
So they're the check and balance against any kind of fraud or misrepresentation.
An essential one. And finally, you have the administrator.
The back office, the accountants.
Well, yes, but it's so much more complex than just bookkeeping now. Of course, they calculate the net asset value, the NAV, but they also do independent price verification, they manage the entire investor register, and, this is a mammoth task today, they handle all the international tax reporting, CRS.
That's a really good point to pause on. The sheer complexity of reporting for thousands of investors across dozens of countries, that's not just calculating P&L.
Absolutely not. The regulatory burden on the administrator is immense. Their expertise is absolutely critical for keeping the fund compliant and avoiding penalties.
Okay, so we've got the structure and the governance. Let's talk about the money. Section 3, investor economics and risk management. What are the typical fees investors should expect?
The fee structure is pretty standard globally. You're looking at a management fee of, say, 1 to 2% of NAV, and then a performance fee, usually in the 10 to 20% range.
But the key for investor protection is the high watermark, right?
Almost always, yes. The performance fee is nearly always subject to a high watermark.
Can you just break that down for us? How does it actually work?
It's a fairness mechanism. It just means the manager only gets paid a performance fee when your investment hits a new peak value. If the fund loses money one year, the manager has to earn back all of those losses for you before they can charge another performance fee.
So it directly aligns their incentives with generating new profits for the investor.
Precisely. It builds a lot of trust.
Okay, what about liquidity? Getting your money out. If dealing is, say, monthly or quarterly, the fund needs tools to handle a rush for the exits.
It does, and those tools have to be clearly defined in the legal documents. The most common are gates. A gate just limits the total percentage of redemptions that can be processed in any single dealing period.
To prevent a fire sale.
Exactly. And then you have side pockets.
What's the specific use case for a side pocket?
A side pocket is used to isolate a specific asset that's illiquid or hard to value. You wall it off from the rest of the portfolio so you don't have to sell it at a bad price to meet redemptions from the liquid part of the fund. It protects the remaining investors.
And if things get really bad?
Then you have suspension provisions. The fund can just temporarily halt all dealings to prevent a systemic collapse during extreme market stress.
And all of this falls under the AIFMD risk framework. It mandates a whole host of risk management procedures.
It does. You have to formally manage market, credit, counterparty, liquidity, and operational risks. You have to measure your leverage in very specific ways, and importantly, you have to conduct regular stress testing and scenario analysis.
To see if the fund can actually withstand a major shock.
Right, to make sure it doesn't break.
Okay, let's get to the final, and for many, the most important piece of the puzzle. Section 4, the tax advantage. Luxembourg is known for tax neutrality. How's it work?
The whole system is designed for predictability and to avoid tax leakage at the fund level. So, for the corporate structures, like a RAIF or a SICAV, they are simply exempt from corporate income tax and municipal business tax.
So they don't pay corporate tax at all. What do they pay?
They pay a very small annual subscription tax. It's called the taxe d'abonnement. The standard rate is just 0.01% of the fund's net asset value.
0.01%. That is incredibly low and, as you said, very predictable.
It's the cost of doing business in the regulated framework.
And what about the SCSp, the partnership we started with? How is that treated?
The SCSp is treated as fully tax transparent, a flow-through. The entity itself isn't taxed in Luxembourg at all. All the income and gains flow directly through to the partners, who are then taxed in their own home countries.
Which is perfect for international investors who need to use their own country's tax treaties.
That's the entire point. It takes Luxembourg out of the tax equation at the fund level.
We also need to quickly touch on SPVs, special purpose vehicles, because you see them used a lot underneath the main fund.
They're essential for certain strategies. A fund might use a Luxembourg SARL, that's a corporate entity, to hold specific assets, like a portfolio of loans or a real estate asset.
And that SPV is taxed like a normal company.
It is, yes. It pays a standard corporate rate of about 25%, but and this is the key, it can benefit hugely from Luxembourg's participation exemption regime and its huge network of double tax treaties.
So the SPV is like a strategic tool for certain assets, allowing the fund to access treaty benefits that the transparent SCSp can't get on its own.
You've got it. It isolates risk and optimizes the tax treatment for cross-border investments.
And for the end investor, when the money flows out of Luxembourg, what's the tax situation?
Generally, for non-resident investors, there's no Luxembourg withholding tax on distributions or capital gains. This reinforces that neutrality. The investor just deals with the tax in their home country.
Fantastic. So to sum it all up, what we have is a robust, highly efficient platform built on AI-FMD compliance and designed for tax neutrality. For a manager listening to this, what's the real-world timeline to get this all done?
If you're organized, from the day you finalize the strategy and start signing up your service providers through all the legal docs and bank accounts to your first close, you're typically looking at somewhere between 10 and 18 weeks.
10 to 18 weeks. That is remarkably fast to launch a fully regulated institutional-grade platform.
It is. And that brings me to a final thought for you to consider. That speed, especially with a vehicle like the RAF being operational within weeks, isn't a sign of weak regulation. It's actually the opposite.
How so?
It's the counterintuitive result of rigorous mandatory professional oversight. The only reason it's fast is because the AI-FMD forces you to have the AI-FM, the depositary, and the administrator all engaged and coordinated from day one. The shortcut to market is only possible because of mandatory governance.
So the speed is actually a function of built-in mandatory institutional oversight.
A fascinating way to look at it. Thank you for walking us through this so clearly.
My pleasure.